Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Thursday, May 21st. We're recording at 9:15 p.m. Eastern Daylight Time, and this is episode number 55. We will not be back next week. We are on vacation, so this is your starting lineup. Number 1, we're going to recap the first quarter earnings of 2026. The quarter is in the bag. It was a stellar quarter, but it was flattered by AI investment gains from Google and Amazon. We'll get into the details on that. Number 2, the global yield shock. What is behind it, and is it sustainable? And number 3, Walmart earnings. We tried to figure out what we could learn about inflation and the U.S. consumer from the world's largest retailer. So back to earnings. By any measure, the first quarter of 26 earnings were stellar. But they were so good, we had to dig deeper and figure out, was there anything in these numbers? And lo and behold, we found out that they were flattered by over $50 billion in investment gains, AI-related investment gains from Google and Amazon. So the S&P 500 reported earnings growth of 28.4% year over year, but the adjusted number is closer to 18 to 20% growth year over year. Revenue growth was fantastic and unchanged at 11.4% year over year. The net margin was reported at 14.8%, but when we adjust it for these $50 billion of investment gains, the adjusted margin falls to just below 14%. Still fantastic, close to record levels. And we also discovered another way to look at this quarter, which is looking at the S&P 493, which reported 17.4% year-over-year growth. Very good. That's a useful proxy for the underlying market, and we think that's probably the best overall look through to how good the quarter was, and it was very good. So artificial intelligence boosted earnings through 2 channels. The first channel is just through real operating growth, and AI had a very significant impact on that. But it also impacted earnings through non-operating investment gains, the ones that we talked about, over $50 billion from the combination of Google and Amazon. So the first quarter confirmed to us that the profit cycle is healthy, but the reported number is overstated and overrated. Investors should focus less on the reported 28% and more on the high teens growth, which is still very strong, but less euphoric. Now on to the global yield shock. Government bond yields are rising around the world and not just in the United States. Warflation caused by the Iran-US conflict, which is really challenging food production, and we see this in agricultural commodities in the US, rallies in corn, soybeans, and especially wheat. We see it around the world where the most important caloric crop is rice for the world, and the price of rice is rising pretty dramatically. So when you get energy prices and food prices rising in tandem, inflation expectations tend to rise, and we're seeing this globally. We're seeing it in the United States, but we're seeing it especially in Japan. Japan has been the rate leader in this backup in yields. Japan's 30-year bond yield hit 4.2% this week, the highest in over 30 years. The Bank of Japan finds itself behind the curve with a policy rate of only 75 basis points and an inflation rate somewhere between 1.5% and 2%. Governments worldwide are running large deficits on top of large sovereign debt loads. Massive spending is ahead for most countries for defense, for climate, to support artificial intelligence, for rising entitlements and healthcare spending on aging populations. There are trillions of dollars that are going to have to be spent on these things. We think the Fed is risking falling behind the curve with inflation reaccelerating. once again. The U.S. 10-year Treasury yield is trying to break out of a 3-year wedge pattern. This has been a range-bound market for over 3 years. And usually when you have a range-bound market for a long time, that energy is building up. And it looked like we were going to break out of that wedge this week, and we did peak above it. But as of today, we came right back into the wedge, and it's not decisive yet. So we'll see. But all G20 countries have rising yields. I looked at every single one of them. They all have rising government bond yields except for one, and that one is China. China's bond yields have been falling for the last several years from 4%. Today, they reside at a very lowly and outlying 1.75%. This is a huge advantage for China. In an era of unprecedented government spending needs, they can borrow by far more cheaply than any other major country. Just like we talked about last week, where natural gas is a huge advantage for the United States, very low government borrowing costs are a huge advantage for China. Now, on to Walmart. Walmart printed an inline quarter for fiscal first quarter of 2027. They did 66 cents versus the estimate of 66 cents. The market didn't love that. It wasn't a beat. The stock fell 7.3%. Today, the new CEO waded into his first conference call with the stock down, and we listened to it for different reasons than most people. We're interested in inflation. We're interested in the look through to the U.S. consumer. And of course, there was lots of bullish AI speak on the call. That's obligatory in today's world. You hear this on every single call. But U.S. comp store sales were up 4% in the quarter. Solid, but not very spectacular. It's less than nominal GDP growth. And the market's really competitive, said management, especially in food where consumers are really hurting. Consumers are feeling pressure. And one way that Walmart gauges pressure on consumers is to look at how much gasoline they put in their tanks. Ingenious. Interesting way to look at it. But in the last quarter, the average gasoline fill was less than 10 gallons. That's back to the same level it was in the bad old days of 2022 when we had double-digit inflation. Management went on to say that quarter over quarter, inflation in the first quarter was up 1%. But it would have been up 2% without 100 basis points of egg deflation. Eggs are really an important part of the consumer goods basket in the United States. Here's the best quote from the whole conference call, straight from the management's mouth. If the Iran war persists, expect higher inflation in the second quarter and for the remainder of 2026. So every day that goes by that this war drags on, the inflation picture gets darker in the United States and in the world for that matter. So do the work, endure the fog of war, and have investment courage.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.